Hello, everyone. Tony Warfield here. Thank you so much for joining us tonight. It's Tuesday, and it's the
Hmm.
last Tuesday of the month. I know, celebrate, celebrate. So, what this really means is this is the last 2 days of my birthday month. So, you still have a chance to get out there and get me a gift. No,
I'm
I'm
gonna
just kidding.
stop by Mercedes-Benz to see what they got available.
I
Yeah,
thought this was it.
that's what I need. That's what I need. Well, you know what? I'm not a gifty person, so what I tell people is like, you know what? I do love to eat. So if you have a specialty that you know how to cook, I would rather have that because I can't make that, right? I can go buy anything, but my sister, she makes this banana cake. Oh man, it's delicious.
Do you
I
eat
don't know.
granola?
I don't know how to make it, and I'm a baker, and I don't know how to make it. So every year, I just want her to make that banana cake for me, and we're good,
Do you
right?
eat granola?
I do.
Okay.
I eat pretty much everything. I don't like ketchup though, so there are restrictions. But enough of that.
Sorry, you
So
don't like what?
I don't eat ketchup. I'm not a fan of ketchup, but I do love
Oh,
tomatoes, right? So tonight this is actually kind of a soft presentation. The purpose of this discussion tonight, which is why I have so limited guests tonight, is a lot of the presentations over the course of the past 3 months, the questions that would come up would talk about some of the retirement plans, some of the life insurance plans, and how they compare to each other. Which ones offer the highest interest rates, or which ones have the best options or the best benefits available. So, what I wanted to do is go ahead and set up an opportunity to where we can just talk about it, right? We can just take a look at all the various plans, and maybe not all. Tonight's discussion is index universal life versus the Roth IRA and the 401k. So as you might have seen in the news lately, um, the market it's had some challenges, and we all
Hmm.
we all have our opinions of why the market has had these challenges, and I'll do my best to see. I told you, Miss Moore, go ahead, let her in. Um, I do my best to stay away from politics, even though I'm a very political person. But sometimes these things are unavoidable, right? So you have families, you have people that predominantly baby boomers. The baby boomer generation started out back in 1946 to 1964, and all these years later, 50, 60, 70 years later, they're starting to retire. What's interesting is as they are retiring, you have the second largest now, but the second largest, but economically the largest generation of people retiring. So all the money that they were putting into the country's GNP, now that's starting to be limited, and now they starting, hey, we want our money. We want our retirement funds, our pensions, we want our social security checks, we want our money. But because our government is not as fiscally responsible as they should be, instead of taking a hit on themselves, they would rather further tax the American people, i.e., $880 billion in cuts so they can fund tax cuts for people who don't deserve them. So again, I'm not going to go too far into that, but you understand that when you have this many challenges, it will affect how the markets work, how the economy works, and of course, if you're looking to retire in a short amount of time, it's going to affect your ability to retire when you are ready to retire. Particularly if you are looking to retire within the next, 2 to 5 years, it's not likely that the market is going to have the type of recovery that we would pray for in the next 2 to 5 years. And there's a specific reason why. And again, hint, hint, I'm not going to give you any political reasons why. But you can imagine that if you're trying to retire right now and your retirement number was, say, $1 million, you have $1 million in your qualified account. And before I go any further, you have qualified accounts and you have non-qualified accounts. So qualified account is an employer-based account. Basically, it's money that's being taken out of your paycheck, that's being contributed to your retirement plan pre-tax, right? So that money has to be taxed when you get ready to retire. Now, what's messed up about that is, what do you expect taxes to do when you get ready to retire? Do you think they're going to go up, or are they going to go down? Does anybody know? They're going to go up. So, and especially with the new tax code that's coming out, so if the taxes are going to go up, you're actually going to be paying more in taxes, right, in a situation where the market is declining. So if your retirement number was $1 million and you are slated to retire in the next year, 2 years, 3 years, and the market just dropped 25%, well, your $1 million is now $750,000 and it hasn't been taxed yet. So you can go ahead and knock an additional 40% off of that. So now your retirement is looking more like $475,000 or maybe $500,000 instead of $1 million that you were expecting. And a lot of people think, hey, it'll recover, it'll recover. If it will recover if it has time. But the challenge is you're retiring in the next 2 to 3 years, maybe 4 years, right? And as long as things are going the way that they are, the way that the budget is being handled, the way that money is being reallocated, the way that these various cuts are being basically damaging everyone's retirement situation, as long as that continues to happen, your retirement schedule may have to be modified, right? So in the recent months, we were talking about, well, Tony, with everything that's going on right now, what other options are available, right? So that's why I wanted to be able to talk about this. This is going to be a two-part discussion because there's a lot of information for us to discuss. But tonight, I wanted to be able to just I'll share my screen if I can find what I'm looking for. Stand by. Let's see if I can find it. It won't let me do that. Okay, let me see. Y'all have to excuse me. It's been a day. It's been a day. But the good news about today is I'm never in a hurry to rush through my day. So I take them as they come. So
if you click at the bottom of your screen, it should pop up. I
oh
just
no,
did mine.
no, I just didn't have it available. That's all.
Oh, okay.
So yeah. So now I have it available. So let me go ahead and bring it on. All right. Can y'all see my screen?
Index Universal Life versus
Yes,
Roth IRA.
that's me right there. So of course, because of the questions that I've had, we're going to talk about more than just these two. So it's just going to be this slide and this slide. Now this slide is important because I want to use this slide as an opportunity for you to take a look at what's available out there, right? So let's talk about that, right? So can y'all see my screen? Is it clear?
Yeah.
Sweet. All right. So you have so many different types of accounts like out there. You have so many opportunities to store your money, whether it be in a highly liquid situation like a checking or savings account, or you might have your money in kind of a mid-level situation like a 401k or a certificate of deposit, or it might be something a little bit longer term, like maybe an annuity or maybe some fixed retirement plan where you're getting some matching funds, right? But it might not always be exactly what you expect it to be. So I want to be able to show you some of the differences in these accounts. So if you can see my screen, we're looking at life insurance products. We're looking at employer-sponsored pre-tax programs. We're looking at banking products, and we're also looking at individual retirement accounts. And you can see there's a lot of locations, and this is not even half of them. That's what's so messed up about it, right? But this is an opportunity for you to get an idea of what's available because you might be participating in, say, a 401k or a 403b or 457, or maybe a thrift savings plan. You might have a checking account, you might have a savings account, but are there other options available for you to be able to maximize the growth of your money, especially when you have a market that's suffering like it is today, right? So, I want you to look at a couple of items here, right? So we only have a few people on tonight, but I'm pretty sure that everyone knows what a 401k is, right? And most of the time, if you look at what's going on in the market, many people's 401k has turned into a 201k, right? It's just been cut in half. And that's actually happened to me multiple times. The dot-com crash 2001, the housing market debacle of 2008, you're looking at 50% and 40% losses during those times. So it's essential that we understand how to make sure our money is as protected as possible, and understanding each one of these different types of accounts will help us do so. So, I want you to be able to look at this this grid, and understand exactly what's out there. So let's talk about the employer-based plans that's out there right now. So you have the 401k, most people can apply for those, right? Employer-based. You have the 403b, that's usually for, teachers or any nonprofit organizations, 501c3s. So if you are a teacher or you have a nonprofit, you would have a 403b. If you have a 403b9, that's usually for your pastors or church-related organizations. And then you have your state and local government employees, your 457s. Now you also have another plan called CalPERS. That's usually for California. I don't have that here because that's kind of out of the scope of what I'm trying to work with right now, because we don't do anything with those. We don't even convert those. So I'm not even going to talk about the CalPERS. When you start looking at these various employer-based plans, the way that they work is the money is being taken out of your gross income pre-tax, and it goes into an employer funded plan where they can possibly match anywhere from 1% as much as 6% or higher, depending on whether you're an executive, salary, or standard hourly worker. Now, in 2025, there are limits to the amount of money that you can contribute to your employer-based retirement plans. It's usually about $23,500 if you're under 50. If you want to catch up over 50, you're looking at $31,000 total. And if you have a high catch-up requirement, you're looking at ages from 60 to 63. They'll allow you to go ahead and put about $34,750. But in every situation, the most you can put away is about $70,000 a year, right? If you drop all the way down to the IRAs or the individual retirement accounts, it has similar limitations, but there are some differences, right? So when you look at the individual retirement accounts, you're looking at about $8,000 a year for over 50 and $7,000 if you're under 50. But then you have what is called a Roth IRA, right? Or a Roth 401k, right? So if you look over in the taxation column, you have the 401k, 403b, 403b9, 457, and the 457b. The B is not there. That's too bad. Sorry about that. And those are all pre-tax. But when you start looking at the IRAs also are pre-tax products, but you have a couple of them which are retirement programs, but they're paid with post-tax or after-tax dollars. That means the IRS already got their money, okay, and now you are paying into this fund for your retirement, and any withdrawals that you get, they will be given to you tax-free, which is great, right? So when you start looking at the 401k and you start looking at the Roth IRA, the 401k is a qualified account, meaning that it's paid with pre-tax dollars. The Roth IRA is a non-qualified account that's paid with post-tax dollars, right? So we want to make sure that is clear. But then there is what is called the Roth 401k, which is also paid with post-tax dollars, but that is also a non-qualified account. But it is a retirement account, just so you know that that's available, right? So you might ask, well, which one of those are the best, right? So if you're just looking at IRAs, right, or thrift savings plans, or Roth IRAs or 401ks, it really does depend on what your risk tolerance is, right? So you understand that if you're someone that looks at your account daily or weekly or monthly, depending on the intervals that you're going to be looking at this information, that will pretty much let you know which accounts you can handle, because many people, for example, with the 401k, when they get started at their job, they usually are allowed to participate in the company's retirement plan probably a year or two after they've started. If you're a salary employee, maybe after the first 90 or 90 days or 180 days after you started. After you've vested yourself a little bit, they'll allow you to participate in the employer's retirement plan. And the great thing about that is if they allow you to participate, some of them they offer anywhere from 1 to 6% matching. And what I will tell anyone is if the company or the employer is matching any funds at any level, you make sure you match what they are willing to match. So what does that mean? So if they're willing to match up to 6%, then you make sure you put away up to 6% so you can get their 6% match, which is a total of 12% that's being contributed to your retirement plan, right? That's free money. You want to take it, right? But if they are not matching any amount of money, then you want to reconsider where you're going to put that money. For example, say you want to personally contribute 20% of your income to your retirement savings, right? Great. If the company is matching 6%, automatically you know you're going to be putting 6% to your employer-based retirement plan. But what do you do with that other 14%? That's the question. Because what ends up happening is you understand that because these are pre-tax or qualified plans, that means that you're still going to be taxed on that money, right? Which is great. Not. But at the same time, because these are plans that are basically put into the stock market, or the money that you are putting into these plans is being directly invested into the stock market, your retirement plans, employer-based retirement plans, and even your post-tax retirement plans are subject to market fluctuation. So if they are subject to market fluctuation and you're only looking at your account once a year, that is putting a whole lot of trust into a system that you don't understand. So putting your money into a 401k that you don't understand and you don't look at it for once a year, you could potentially be threatening your ability to retire when you are ready. And unfortunately, we see that happening in spades across the country because a lot of the baby boomers who are preparing for their retirement are realizing that they have to extend their working years 2 or 3 years to be able to get to the retirement number that they want, solely because the losses that they incurred over the past several years, right in the twilight of their retirement situation, right in the twilight of their careers, now they look like, oh my God, here I am in the sunset of my life and I have to go back to work because I don't have enough money. And what's interesting about that is most people are more afraid of not having enough money for retirement than they are of dying. Because guess what? If you don't have the funds that are available, how are you going to be living? That's terrifying. And many people, myself included, if you're an independent person, you don't want your kids to have to, feel like they have to take care of you. You don't want your kids to be responsible for looking after you financially, physically, even emotionally, right? You don't want that. You want your kids to be able to enjoy their lives and do whatever they want. And most people, because they feel that way, okay, I need to make some more money. So let me go back, let me extend my employer situation. But then some of them will run into the situation where they don't even have that option. They are still forced into retirement. So it is essential that we have a better understanding of what's available out there. So let's take a look at some other options, right? So when you look at your banking situation, everybody knows in every one of my presentations, I like to pick on Chase Bank because Chase Bank offers the absolute least interest rates for their savings account. So I'm going to pick on them. We don't like you, right? So you see here that I have in checking account and savings account, a standard checking or standard savings account is offering about 0.01%. So in order for us to determine how fast our money grows, we use what is called the rule of 72, right? So the rule of 72 says if you are to divide your interest rate into 72, that will tell you how fast your money will double. So 0.01% divided into 72, that's going to take you about 720 or 7,200 years or something like that. I don't know about you, but I don't have that kind of time. So we need to make sure that we put our money where it's going to at least be able to outpace inflation. But the good news about a checking or a savings account is if you have an emergency situation or emergent situation, or you have a situation where you're just paying your standard bills and you don't want to use a credit card like I would recommend, the money is available to you for whatever uses that you might have, right? But you only want to be able to have enough money in your checking and savings account so you can manage that liquidity properly. If you got $100,000 in your savings account but only $10,000 a month of expenses, you're literally wasting $90,000 worth of potential economic growth, right? And we don't want to do that, right? So we want to be able to start looking at where we're going to put this money. Now, there are high yield checking and savings accounts out there. Right now, I saw one as high as 5.20%. And with inflation hanging around 3.2, 3.4%, that's actually outpacing inflation a little bit. Now, I know during COVID, we hit 9.4. Terrible, right? So everybody took a hit on that, even some of the high yield accounts. But it was only a temporary span, dropped back down to 0.7 at one point, hung around at 1.4, and then went right back to the average of 3.2, 3.25, I think it was. But again, it's important to make sure that we have our money in an account that we need right now, but anything that we don't need, we need to make sure that money is working for us. So again, you're looking at your individual retirement accounts, you're looking at your employer-sponsored accounts. Those are all subject to market risk. So again, the title of this presentation is the Index Universal Life versus the 401k and the Roth IRA. Why is that important? So, as a life insurance strategist, one of the things that I talk to people about is how they can get the maximum amount of protection with the minimal amount of money, right? So how do you do that? Well, you get educated sooner. And unfortunately, a lot of us, we weren't given that option, considering a lot of this discussion I'm sharing with you today is really dinner table discussion with most communities. It just was not privy to many people that in our communities, and that's highly unfortunate. But here we are, we're doing what we can right now to be able to remedy that situation. So there's various types of life insurance products that are out there that will allow you to get a higher yield, but also be able to offer you other benefits to make sure that if something were to happen to you, your money is not blown up, thrown away, destroyed, consumed. The reason why this is important is because I want you to imagine you are a business owner, but you're the only one that owns the business, right? You're the sole employee of that business. That means that if you are not working, your business is not making money. If you're an hourly employee, if you're not making money, your job is not making you money. You don't have any income coming into your house. So Lord forbid, but sadly it's pretty often that it does, something happens to you. You end up having a critical illness, a chronic illness, or Lord forbid, a terminal illness that takes you away from your ability to produce an income. When that happens, you need the time to be able to recover from whatever illness that you might have, if God is going to allow you to recover from that. But even though you're in this recovery, your responsibilities don't take a break, right? So you still have to pay your rent and your mortgage. You still have to pay your gas and your lights, your cell phone, your water bill. You still got to eat, still got to have clothes on your back, right? So there are many things that you must do to be able to maintain yourself, even though you're still trying to recover. So what's unfortunate about that is most people who are working, they're paying these exorbitant costs for medical insurance, right? Even though they have the medical insurance and the medical insurance is covering, the vast majority of some of the expenses, if they have a decent enough coverage, it's not covering everything. And what ends up happening is that the medical insurance is insufficient to be able to handle your current medical situation. A good example, end-stage renal failure, heart disease, heart attack, you have some form of cancer, and the chemotherapy and all the other treatments that you have ends up being at a cost that's higher than your insurance will cover. you'll end up getting yourself into a financial situation where a lot of the money that you might have in your emergency fund, checking accounts, and various other accounts starts to get consumed. And then you'll end up going into a bankruptcy situation. And oh my God, going into a bankruptcy situation and you still haven't been cured of your illness, a lot of people end up expiring because of that. That's happened to several of my family members. So it's essential that we understand what is available out there. So when I talk to you about, having the proper protection in place, I'm talking to you about what are called living benefits, right? So when you look at the various types of products that are available, you might have heard about term life, you might have heard about whole life, but this discussion tonight is about the index universal life policies, right? So when you compare that to the Roth IRA that you're using after tax dollars, or you compare that to the 401k to where you're using pre-tax dollars, the index universal life product, it allows you to use one premium to pay for the life insurance protection. That means if something were to happen to you, you have whatever amount of death benefit available that will allow you to be paid by your life insurance policy while you're still alive. Now, the reason why I bring this up is because I know, insurance is kind of a touchy subject. Most people don't want to talk about it. But when you think about the power of what this offers, it's an opportunity for you to make sure that your financial legacy gets passed on in a positive manner, meaning that you actually contribute to your family's bottom line economic well-being versus passing on more debt and more responsibilities that many people are unable to be able to handle, in addition to what they're already dealing with on their own, right? So when you have a type of protection like this in place, you have those living benefits that'll offer you protections against a chronic illness where you cannot do 2 out of your 6 activities of daily living. If you can't do that for 90 days, then you get a portion of your death benefit to help take care of your financial responsibilities while you recover. If you have a critical illness, my mother, she passed on from kidney failure, end-stage renal failure, cancer, heart attack, and stroke, various types of illnesses where it's going to take you some time to recover, possibly even years, then you still have to eat, still have to have a roof over your head, still have to take care of your financial responsibilities. So while you are still alive, it's going to be able to take care of that for you, which I think is great. Another component that I really love about this is it actually allows you to grow cash tax-free. So as you are growing this cash tax-free, as you look at this grid here, you see where I show you the risk column. So you see where I'm showing you the 401k, the 403b, 457, the IRAs, even the Roth IRAs and the Roth 401k. All of them suffer a high level of risk because the money that's being paid into those retirement accounts is being directed right into the stock market. It's being invested directly into the stock market. So if the stock market does well, you have the potential to do very, very well on your plans. But if the stock market is reacting like you've seen over the past couple of months, especially with the threat of the tariffs a few weeks ago, then you can imagine that money is going to drop significantly. And what's very unfortunate about a lot of these policies or these plans is they drop rapidly, but they're slow to grow. They drop rapidly, but they're slow to grow. So the reason why this is significant is going back to the beginning of the discussion. If you're someone that's looking to retire in the next couple of years, that slow growth is going to impact your ability to retire when you're ready to, when you're scheduled to. So we got to be able to look at other options that'll be able to give us the economic growth and limit the amount of risk. So that's one of the benefits of being able to have an IUL, because you don't have to worry about suffering any market risk. So when you start looking at some of the contributions, as we get older, we're in our 40s, we're in our 50s, we're in our 60s, you can see that, with the 401k, you have a limit, 23,500 a year. You have a limit, 31,000 if you're over 50. And if you really want to catch up over 60 to 63, you're looking at about $35,000, 34,750, right? So that's pretty good. It allows you to really start contributing. But what happens when you really want to be able to put some money aside, when you really have to, do some things? If you have the means to be able to contribute more, these limitations could stifle your ability to be able to contribute any pre-tax and even post-tax monies, right? Because of the IRS codes. But when it comes to having the proper protection in place, there really is no limit to how much that you can put away. And as long as it passes suitability, if you're trying to get an annuity, or if it passes and it doesn't become a modified endowment contract, it will get, favorable IRS treatment with whatever your face amount might be for whether it be an index universal life or even a whole life in this situation or universal life. So when you look at the various types of plans that are available, there's no one size fits all situation. You can understand that, right? I'm not advocating that you don't put money in the stock market because there's a lot of money to be made in the stock market. In fact, if I were you, I'd really be paying attention to what's happening in the market right now, because as all the prices are starting to come down, some of these organizations slash companies, they're not going anywhere. They're just having a downturn right now. So that means you have a situation where the shares that you can buy into are far less expensive than what you might have seen a few months ago. So it's actually affordable, and it's going to recover at some point. So you can actually make a significant amount of money. One of the things that excite me about the company that I'm with is we're actually looking to go public in the next couple of years. And I'm excited about it. Anytime you hear an IPO, the letters IPO, the acronym IPO, that's called an initial public offering. So whenever a company goes IPO, what they're trying to do is they're trying to get as much money, as much capital brought in as possible, so they'll be able to have the expansion that they want. Now, what's great about that is employees slash clients or people who are in a position to benefit from that IPO can actually purchase shares before the company actually goes public, right? So if you're looking at what's going on in the markets, you still have new businesses starting. You still have some businesses that might have a slight economic downturn, but you're able to buy shares at a bargain basement rate, which will allow you to really have a chance to grow your money quickly. So just like with the IPO, give you an example of what I mean. If the company is expected to have a opening bid of $20 per share, and the company sold you several shares for $15 per share. As soon as the company officially goes public, you just made $5 per share, right? 33% on your money the second they ring that bell. That's huge. And then if you look at some of the economic downturn some of these companies are dealing with, right? If you're buying into that, as soon as the market recovers, it's going to jump right back up as soon as we start getting that consumer confidence. And that's the real subject here. It's consumer confidence, right? You're talking about the shareholder confidence. Other countries and their confidence in the United States, their confidence is really what makes the difference because they're starting to invest in the United States as well. So as all this uncertainty is going on, you can imagine that your 401ks, your IRAs of every sort, your 457s, your 403bs, they're going to be having some challenges right now where you're going to see some fluctuation. And sadly, that fluctuation has an average downtick, right? So when you get into the situation where it starts to threaten the bottom line, the lower level of your tolerance, when you get to that point, it is essential that you start considering other options of where you can put your money. So when you start looking at, okay, I'm getting ready to retire in 2 years. Do you still want your money into a high risk product? Or maybe you want to start diversifying your money a little bit more so you can hedge against any potential losses, right? Somebody asked me about the gold index a couple of weeks ago. And I like the gold index for one specific reason. Regardless of how the market is doing, whether it's up, whether it's down, gold is always, gold is most often in the positive side of the growth, right? So meaning that you very rarely see the cost of gold depreciate, right? Now, when the market is doing well, gold does well. When the market is doing poorly, sometimes it actually does better when the market is doing poorly, because I guess people are, I don't know if the John Wick days or a situation where people oh my God, we need to start bartering. You got to start the barter system again. So I want to be able to have my money with me, right? So they start investing in gold even more. So you have various indexes that are out there, but when you look at what's available, so I will tell you this, to be honest, the indexes that are available for your mutual funds and your retirement based programs, they have a pretty good mix. But the problem with that mix is if you're not paying attention to what's out there, it's really not going to help you if it starts to decline because you're not aware of that declination, right? Same thing with your IRA. It has a really, really, really good mix, but if you're not paying attention, you could, suffer some losses. The great thing about having an IUL is even though it has a limited number of indexing options, the options are not tied directly into the stock market. So what that means is it's hedged against the stock market. So you get to participate in some of the gains of the stock market, but you suffer none of the losses. And because of the relationship that you have with your financial professional, me, we do what are called yearly reviews, where we take a close look at your situation with each one of your statements every year, right? To make sure that your IUL is profitable. So if it's not profitable in whatever indexes that you are using, maybe one, maybe two, maybe four, multiple. Whatever is doing well, we'll leave it alone. Whatever's doing better, we might shift a few more funds there. Whatever's not doing so well, we may not use that one for that particular year. But the goal is to make sure you have a professional that's going to sit with you to be able to explain to you how each of these indexes will benefit you. But that being said, you still want to be able to have your money diversified. We still want to make sure that your money is in a checking account, savings account, for whatever reason, for your emergency fund or so liquid fund usage. You might have an IRA, you might have a Roth, you might have 401k or 457. You might have a combination of many because you're not tied into any one thing. We got people who have various employer based programs from multiple employers, right? 401k over here or 457 over there, and they might have a private Roth IRA to themselves, and they might also have a couple of IULs, right? Whatever your mix is whatever your mix is. But if you're paying attention to the limits, if you're paying attention to the risk, if you're paying attention to exactly how those indexes are performing for you, you're ahead of the game, right? So what I want to be able to do is I want to open up this discussion for questions. Let me stop sharing my screen. Okay, it looks like we had a few more people pop in there. How are you doing, Mrs. Faulkner, Miss Robinson, Mr. Vic? Hi, Linda. How you doing, Pastor Bowie? Welcome. Nobody wants to show their face today. That's all right.
Oh,
I'll pick on y'all
no,
later.
I would. I'm just cooking, but I'm
Oh,
listening.
okay, that's great. So what's for dinner tonight?
Well, Dr. Span's not gonna want to hear this,
Uh-oh.
but I'm actually cooking steak. Steak with I'm using a chopper to chop up the vegetables right now, and
Okay.
I was thinking of doing like a nice stir fry.
Well, do you know what's so
Yeah.
great about what you just said? Let me show you how you get back on track with these discussions, right? So one of the things I tell people is I want them to be able to have steak for their retirement, right? Because I don't know about y'all, but there were a lot of top ramen days in my youth. There were a lot of days when I did not have opportunity to have steak. There were a lot of days when I didn't have any meat on the plate at all because money was limited. So the fact that you're having steak right now, you enjoy that. Just make sure that when you get some of this right here, cut back on some of that red meat because it's probably not a good idea. That being said, I'm looking forward to that ribeye for my birthday that Dr. Stan's going to get me.
Okay.
So, does anybody have any questions on that?
So I like all of the pros about the IUL. What would be a con?
Well, there are actually a few cons. All right, and I'm full disclosure, no gatekeeper over here. So one of the cons I don't like about the IUL is it does have limited indexing options. So depending on the company that you are getting your IUL with, You might only have a handful of options, maybe 6 or 7 options, but the options that they offer you are pretty phenomenal. Another challenge I have with the IUL is you have what is called a participation rate. You have a cap rate. You have a cap rate with a fee, right? So what ends up happening is because the IUL might have a cap rate, for example, is say the market goes up 20%, right? But your IUL has a cap of 16%, right? What happens is you'll get your full 16%, Ms. Moore, but the financial institution will get that additional 4%. But what's great about that is if the market were to very next day drop 50%, you don't lose anything. You lock in where you were. Whereas if you had that money directly in the stock market, if you had $100,000 the next day you got $50,000. With an IUL, you lock in where you are. And as soon as the money starts growing again, you just start growing again from that. But it is limited to a 16% for a cap. Then you also have what is called a participation rate, which for me is actually my favorite, right? The participation rate, depending on the type of index that you're using, it might offer you anywhere from 105% to 180%, or even 205%, or whatever the previous year's growth was. So if the previous year's growth was 5% and you get a 200% participation rate, they're going to credit your account 200%, right? So that's going to be 10%, right? So that's actually pretty good. Then there's another one, which is also my favorite, which is the fee. And for me, the fee is depending on if I were to recommend something, I can't recommend it because what you want is what you want. But if you're someone that looks at the market regularly, the fee is probably the best thing that you can do. Let me tell you how the fee works, right? So say the fee is 3.25%. Tony, that fee is too high. 3.25%. Yeah, but the market just went up 40%. Are you going to care about 3.25%? You're going to end up taking home 36.75% growth for that year? Go ahead, you take that 3.25%, knock yourself out, right? And then the very next day it drops 50% and you lock in at zero. Whatever you got is what you got. So that's pretty much the real drawback, depending on what the limits are. There are a couple of other limits that the IUL offers. If the IUL is improperly structured, this is actually important. I appreciate you asking that question because if the IUL is improperly structured, it can lapse as you get older. Why? Okay, because most of the time, the people that take advantage of the IUL are people who are in a position to be able to max fund the IUL. If you are not in a position to max fund the IUL, then you have to make sure you pay those insurance premiums or the minimum premium to make sure the policy remains in force. But if you max fund it, meaning that you're using this IUL as an additional potential retirement income source, then you're going to put as much money as you can in it, right? And the reason why that's important is because you can use that money that you're accumulating in that IUL as collateral. Just like with your 401k, you can actually borrow against your 401k, your 457, your 403b, right? But you have to pay those monies back. With an IUL, if you chose not to pay that money back, it just gets deducted from the death benefit from your beneficiary. So there are so many options, but the amount that you're limited bothers me a little bit, and also maybe some of the fees. But the fees over time will be better than suffering any losses over the course of your uses of the IUL. Because if you were to compare it to, say, if you look at the 401k over the past 10 years, so to speak, right? We've had a lot of economic downturn in the past 10 years, 20 years, even worse, right? The key is not to lose any money. So yes, we might be limited to 16% with a cap. We might be having 3.25% on fee, whatever the growth is. But the fact that I don't lose any money overall, I outperform the 401k. I outperform the 457. I outperform the 403b, right? If we're looking at an average of 6 to 10% versus an average of 4 to 5%, that additional 1 to 2% compounding annually after the course of 10, 20, 30 years can make the difference between you retiring at 65 and you retiring at 70. Because 20, 30 years of 2% compounding interest on top of everything else actually grows quite quickly. Again, we're going to go to that rule of 72. If you had $100,000 that you invested and you're getting a 7.2% return, that means you're going to double your money every 10 years. That's a whole lot better than if you have that money into a 2% account where your money's going to double every 36 years, right? So great question. Anybody else? Ask away, because the part two of this is where it's going to really start getting serious. So, Pastor Boyd, thank you for being on. I love it when you come on. How you doing?
I am doing wonderful.
Thank you.
And I know you are.
Oh, I'm a little hot right now. Y'all might have noticed a bead of sweat go down my forehead. Mainly because Miss Moore, she's asking these difficult questions. She's scaring me. Or it could be Miss Robinson's steak that I'm thinking about and I'm hungry. So thank you so much for being on. Did you have any questions, Pastor Boyd?
I'll be honest with you. I had to walk away for a second. So I just came in when you were dealing with the rule of 72 and talking about the compound interest, which I have some knowledge of. So I didn't have
Excellent. So, let everybody know who Pastor Bowie is. Pastor Bowie, he actually is hosting financial education classes every Thursday at his church. And some of the questions that I covered in this, or answers I covered in this presentation, actually came from his church, particularly people that don't understand compounding interest, right? Or people that don't understand all the different investment options right there. I learned something about ETFs. I still don't remember what that stands for, but I understand what it is now. But you have so many options that are available out there. But what I really want everybody to take home from this presentation is, if you are someone who is not financially savvy, definitely connect yourself with someone who can help you, whether it be a financial professional like myself, that's focused on health insurance and life insurance. I'm not a certified public accountant. I'm not a certified, not a financial planner, but I'm very learned on all these different programs that are available. The reason why that is because I have to make sure that when I recommend an annuity, or I recommend an IUL, or I recommend a whole life, or I recommend a term life policy to my clients, I have to make sure I have a fiduciary responsibility to make sure that that product will benefit them, right? Because a lot of people that say, well, Tony, I want to get a certificate of deposit, right? Well, a certificate of deposit is great if you want something that you can put your money away for a short time, but you understand you still have to pay the interest on that yearly, right? The money that you're putting into your life insurance product is not taxed yearly. So any dividends that you're getting, if you're living off of dividends, if any interest payments that you're getting from that certificate of deposit, or anything that you actually are cashing out every year, that is, you have to pay taxes on that. And the reason why this is important that you understand that is where you fall on the tax table, right? So if you're somewhere in the middle of your tax bracket, it probably doesn't matter. But if you're teetering between that 24 and that 28%, you really want to pay attention to what you're doing, because if you take those dividends or you take that payment and it pushes you from the 24% percentile to the 28, now you're going to end up paying more taxes than you had to, right? So you want to talk to your tax professional to be able to make sure that you're getting the right deductions to keep you out of those higher tax brackets. Now, again, we understand that taxes are going to be higher when we retire, because a lot of the tax benefits that you get while you're working, the deductions that you're enjoying, they might not be available to you when you retire. So you really want to make sure you have a tax strategist work with you so you can pay what you're due and not more of that. Because if it's improperly done, then again, you can find yourself retiring at a much later time than you anticipated. And we don't want that, because I don't know about y'all, but I want to still have some life in me when I get ready to retire. You know, I want to still be able to climb up a mountain. You know, my friend Linda Kenyon is here, and she still runs up hills faster than me. I'm not gonna say what her age is, because you know all women are 21. At least that's what my mama told me,
That's
I
right?
thought she was only 16.
16 it is. 16 going once, 16 going twice. Sold.
I'll take it.
Right?
Uh,
Well. That's what we'll say on camera, but in closed doors, when I'm hearing all those joints popping and snapping, you know what I'm saying? I still was strong enough to get out there, and that's my goal, is to be able to make sure that we get this money situation out of the way, so we can enjoy more of our time doing the things that we enjoy doing. So I really appreciate y'all being on. Ms. Faulkner, thank you so much for being on. There's a couple of things that's coming up, you know, since I got a couple of extra minutes. So I'm going to be out at Long Beach City College on that's Friday, May 16th. It's actually going to be this presentation, but far more extended, because I'm going to have case studies, primarily because a lot of the students, they've been following my program, and this is going to be module 3, so they're going to be using a lot of their budgeting information so I can help them devise a literal financial plan specifically for each of them. And with that, I'm going to be inviting a few more guests. We got somebody that's going to be taking care of the wills and trusts, because we have some people interested in, you know, establishing a will and a trust to be able to make that available. We're going to have some credit professionals that are going to be available, because a lot of people express their desire to get their credit situation worked on. And of course, my job is to make sure they have the proper protections in place, so they don't end up suffering any market losses or any personal losses, financial personal losses. So we're going to have a pretty good time there. We also have on the 20th, this right here is, particularly for Pastor Bowie. He's going to love this. I want to talk about the importance and the power of charitable giving. Our pastors are most eloquent in sharing why that's important, particularly in our community, because you have so many people who are fiscally challenged, and being able to have, people who understand the importance of giving back to their communities is very important. So, I got a good friend of mine, Pastor Josie, out of North Carolina. She's going to be hosting that for me, the head speaker. We got a couple of more people that's going to be jumping there that have 501c3s or nonprofit organizations that are near and dear to me. But I could not. I wanted this to be a kind of a fast presentation tonight, because Tammy Moore, I'd like to put people on the spot, right? So tell everybody that I'm about to do that to them right now. So, and it's interesting, because the person I was going to pick up first is the one that's raising his hand. So before I let you go, I want to tell everybody who's on this call tonight, because I want them to have like a 90-second opportunity to talk about what they actually do. So again, Pastor Bowie, he's the pastor of Bellevue Presbyterian Church in Los Angeles. I have Dr. Christopher Spann. He's representing Lifeboat, which is a nonprofit that's near and dear to my heart, because it helps to educate our young people to keep them from going from the prisons and cemeteries into colleges and universities. That's what's best. And then Miss Brene Robinson, she's on tonight as well, and she represents, I forget the name of her organization. Brene, can you tell me the name of your organization, the actual name? Because I keep saying it is for rape victims, and I don't want to say that.
Oh, it's okay. I work for YWCA, Greater Los Angeles, and I work in the Sexual Assault Crisis Services program. And Pastor Bowie, you look very familiar. I think I've seen you off
yeah,
of
we were at the
108th.
108th police monthly
That's
meeting
right.
about 2
There,
months ago.
yes.
Yeah.
Uh-huh. That's right. Yep. Wow. Yeah, let me let me just sit down really quick. I was trying to put my camera on. Hopefully you can
There you
See
are.
me, everyone.
Pastor
I'm
Bowie,
really, really
I'm gonna let her
Excellent
excited.
do
I
her
was
spiel.
expecting.
presentation.
I'm gonna let her do her spiel first, and I'll switch over to you. So, Brene, please tell us a
Okay.
little bit about what you
Okay.
do, please.
Okay, what I do is I put together community educational events. I think of different presentations that are related to, criminal subject matter, human trafficking, sexual assault, sexual harassment. We also do like hands-on activities that are healing and very therapeutic, just to bring awareness to the program and to let everyone know about the services that we offer. Uh, I know I'm going to be really brief, but I also help with survivors going to hospitals to get a forensic exam and also to go to the police department to follow a police report, which is really a hard time for a survivor. But I'm really there to provide emotional support. That's in a nutshell what I do. Thank you.
No, thank you. I appreciate that. I got a chance to meet Miss Robinson a couple of weeks ago at a special event, and she highly impressed me. Her spirit and her passion for what she does is evident, and I couldn't wait to get the opportunity to get her to speak. So she's going to be one of my guest speakers on May 20th,
Yes.
same bat time, the same bat channel. So get as many people on there because one of the things about financial education, it's not just to make the money for yourself, right?
Right.
You want to tithe 10% for your church, but I'd like to think that I'd be able to do a little bit more for the community as well. And that's a perfect segue for Pastor Oliver Bowie. So, Pastor Bowie, would you mind sharing a few thoughts?
Yeah. Well, good evening to all you great people that's on this line, and thank you so much, Tony, for all that you do for our community. And quite naturally, being a pastor, one of the most important things I'm focusing on is your spiritual life and, where you're going to spend eternity. But with that being said, also, we still have to live here on this earth. And in John 10:10, Jesus said that he's come that we might have life, but not just life, but what? Have it more abundantly. And I believe that many of us as believers have just allowed ourselves to just accept mediocrity or just get by, a survival mentality, and here in 2025, instead of surviving, we should be looking what? Thriving. And then also with what God has blessed me with, I try to use what He's given me to give back to our community. That's why we have the God, Money, and Me presentation at the church that's going on to help teach people how to invest money, how to manage money. Because you can make money, but the more difficult part is what? Keeping money. If any of you have any money, it's not as hard to make it, but once you get it, and that's why we see people. So that's part of also not only just being able to gain it, but how do you sustain it and continue to. And Tony said something very important. And if you understand that the Bible says it's more blessed to what? Give what? Than receive, And guess what? That's what the blessing is. If you're able to give, you're in a position of advantage. I tell people I'd rather be the man that's in the position to give or to lend 1,000 than the man in need to have the 1,000. So being able to just teach some principles. And one of the things that I'm working on for us as beautiful Black people is that one of the main missions I'm on is unity in the community. How can we come together? And Tony, I'm sure that sooner or later, how do we collectively put our resources together and begin to build a better world for ourselves and for others? So I think most of you know that one, there's power when we come together. And so hopefully as we continue to move forward and all of us get on that page and mindset, we're able to build the things that we need to build and make this world a better place for ourselves. And if you have children, and then just do the right thing. So I hope that I can be, and not even hope, I have been blessed enough to be a change agent. So you may find me anywhere, see me anywhere, because I'm putting in the work. I'm trying to do what Jesus said. I'm going to work while it's day, because when nighttime comes, nobody can work. And God bless you. And Tony, keep up the good work. And I hope to do something with all of you as we work together to make this world into the world that we would like it to be. God bless you.
You know what? He's he's got this silver tongue, and I don't envy Dr. Christopher Span because he's got to follow that.
He's
So
on my team, though, so he doesn't have to worry.
he's on the team.
He's on my team, and I'm on his team.
I do these presentations, and I got to tell you, these presentations are so wonderful for me because I get to see people at their best. You only see the shoulder, the head and shoulders, whatever, but you see the entire spirit. And every time you speak, Pastor Bowie, it's like an inspiration recharge, and I got to tell you how much I appreciate you for that. So that being said, I'm going to put Dr. Christopher Span on the spot. I got a chance to meet him through Miss Brene Robinson. I got a chance. I just met him yesterday. I just got a chance to talk to him yesterday after, about a week or so of us playing phone tag. And we finally got a chance to have a conversation. And probably about 37.23 seconds into the conversation, he says things like looking after our children, right? You understand, I grew up with a village. Many of us grew up with a village, but right now they're forcing this individuality on everyone, but we cannot function as individuals. We are a community people. So being able to have, Dr. Christopher Span on to be able to share some thoughts, I'm excited about working with him because what he's doing for the community, and he's got a couple of ideas that I think he should share, but he might not want to give that up on this conversation, but we're going to get it out of him at some point. So Dr. Span, can you share a few thoughts, please? Got to unmute you first. Can you unmute? There you go.
Okay. I'm originally from Pittsburgh, Pennsylvania. My wife and I have been down here since 2019. I got a chance to understand a lot of different things. It was a culture shock for me because coming from Pittsburgh, Pennsylvania, it was basically a black-white thing. But I come down here, I see all the black and brown. And my first thought was, oh, all this black and brown, we should be running this state. And we're not. One of the areas that I know we need help in. And I'll be honest, I've worked in a couple school districts down here. Our kids are not being educated. Our kids are being, through technology, the overuse of technology, they're functionally illiterate now. Oh, they can do the basic reading and writing, but when it actually comes to using their imaginations, that's not happening. I'm here to bring back old school education. My major focus through Lifeboat Services, we have an after-school program called the Elite Fleet. I push reading books. I push hands-on education. I push respect, developing self-esteem, developing who you are as a person in relates to the realities of this world. We can't sit back and wait for other people to take care of us. We got to take care of our own, and that's what I'm here for. And so I'm glad to be part of this, glad to meet Mr. Warfield. He has agreed to help me, get the necessary funds. I'm actually working with a group of kids now, and basically I'm just letting you know right now, I need more help. I need to expand the program because too many of our children are graduating looking forward to working at Target, looking forward to working at Sam's. Nothing wrong with those jobs. But why can't we look beyond the small part of the athletic and entertainment field, look at the bigger thing of lawyers and doctors, politicians, because I'm doing it for selfish reasons. In about 20 or 30 years, they'll be running the country. And I want to make sure they're doing a good job. If not, I got to move, so I'm here to get these kids on the right track because the schools are not doing it. The schools are basically collecting our tax money and not educating our kids. So, and like Mr. Warfield said, I have a lot of different things I like to talk about, but as my buddy Miss Robinson is doing, most of us want to go eat, so I'm not going to take up your dinner, but we are going to plan to have Mr. Warfield over one day so I can make him a steak, vegan style. But my wife can tell you I can cook meat too. So, maybe I can have everybody over for because I like to do healthy eating. Like I said, the program is holistic. But I'm going to stop now. And I hope to get to meet every last one of you so I can let you know exactly who we are, what we're about, and how we can work together to, as a pastor, let's exist. No, let's go beyond existing on this planet.
Amen.
Let's
Amen.
be the chosen people we're supposed to be.
All right.
Thank you, Dr. Span. Before I do my post-amble here, we had a hand raised. Mr. Chris Dimbo, welcome to the call. What is your question, please? You're going to have to come off mute. There you go. Okay. I don't know what that is, but all right. That looks like something that's not really what we need. So let me go ahead and remove that. Thank you. All right. So that being said, thank you so much, Dr. Span. Thank you, Pastor Bowie. Thank you, Miss Robinson. Thank you, Miss Tammy Moore, Alvin, Miss Faulkner, Linda Kenyon. She's actually my partner out of Houston, Texas. Did you have any comments before we get out of here, Miss Kenyon?
Not really. You did a great job tonight. And I guess I could kind of piggyback on what I learned about Christopher, that he works with younger people. And so that's kind of my heart. My parents were educators, so I believe in us getting the information, but at the younger ages.
Mm-hmm.
And so I kind of work with some nonprofit younger age kids. And I went to TSU a few weeks ago, and I actually had one of them call me on Saturday to ask me where they can put their money in a high yield savings account on a Saturday morning. I was blown away with that. So things like that really excite me. But that's all I had.
See why that financial education is so important? Because you had the answer to that question, didn't you? That's what I'm talking about. So just so everybody knows, Linda Kenyon, she's actually my business partner. Her and I, we work together. Website is lifeboatservices.net. Thank you so much, Dr. Span. Linda Kenyon is my business partner. She's going to be running operations out of Houston, Texas. And she's an invaluable partner. As a matter of fact, I committed to do this call every week on Tuesday, but sometimes I travel and I'm unable to do so. So Linda Kenyon is my proxy. So she's going to be doing the presentation next Tuesday. It's going to be Understanding Your Money Matters, which basically is basic financial concepts. So please make sure you join her on that call. I'll send out the information, because we want this call to be able to affect all communities as well as all age groups and socioeconomic statuses. So Linda Kenyon, she does a phenomenal job presenting. And it's actually, I'm a little arrogant, maybe a little, but so when I tell you that she does a better job than me in this presentation, she does. She's absolutely phenomenal, and she's highly informative. So make sure you have pen and paper ready. The following week, I wanted to be able to talk about that one as well real quick. The following week, which is the 13th, I have a gentleman that's going to be talking about starting small businesses. And then on the 20th, I'm going to have everyone on to discuss the importance and the power of charitable giving. So make sure you look out for some of the invitations for that over the next few weeks, because we really want to get organizations like Lifeboat and the YWCA and Bellevue Presbyterian Church and Black Infant Health and All for Kids and all the programs that we want to support that benefit our communities, right? It's essential, and having this discussion about why money is so important to be able to start giving back is so programs like these programs not only help the underserved, but they also give jobs to many of the people who may be underserved. Right? So this is an opportunity to make sure we look after our kids financially, as well as just making sure they have a roof over their head. So with that, I'm going to go ahead and close out. If no one has any other questions, thank you all so much for being on tonight, and I look forward to seeing you all next week. Have a good night.
Thank you.
God bless you, Brother Tony.